Hi, I'm Madison Malone, and in this Eyes on Tax video, we're talking about the trustee tax rate. And I'm joined by Mark, Ian and Alan. Hey guys.
Hello. Hey Maddie.
Lots to chat about. Ian, perhaps you could start by telling us the change to the trustee tax rate and why a change was made.
Yeah, sure. So from 1 April 2024, the trustee rate went from 33% to 39% on trustee income. That's income that has been retained in the trust. It was there to align with the top personal tax rate to stop trusts being used to reduce income on personal services income and other types of income.
So it's been in place for about a year. Mark, what are the observations that you've seen since this has come into play?
I think Ian's set that up quite nicely. So the trustee tax rate is now aligned with the highest marginal personal tax rate, 39.39. But we do have another tax rate. The company tax rate is 28%. So we're starting to see, and perhaps for other reasons, trusts not so much in favour, disclosure regime, etc. But trusts maybe not as flavoursome as once they were, and companies starting to have resurgence.
What about PIEs? Are they more, to use your term, flavoursome?
Pie is very flavoursome. You are allowed to have some fun with trusts and tax, but you can't have too much fun. And Inland Revenue has given us some guidelines as to what might be considered to be too much fun. But one of the things that they've put out is investing in a pie is fine. So a trust can invest in a pie and enjoy a top tax rate of 28%. By putting that in a document saying that's fine is almost ludicrous, but it does because it's obviously fine. But it does tell you where things could head if you push it too far. So that's probably for you, Alan, I think.
What's too far, Alan?
Yeah, good question. There's an incentive for everyone not to know how too far is because it keeps that line quite grey. But there probably is more of an incentive for people to put income-generating assets into a company structure rather than a trust structure because companies pay tax, company tax rate 28% versus the 39% rate that's already been talked about. Ultimately, the company tax rate is only an interim tax. When those profits are distributed to a shareholder, if it was a trust shareholder, for example, that would ultimately be taxed at 39%. There's any imputation credits that come with dividends distributions. So whilst there might be an incentive to invest via a company rather than a trust, it's only a temporary thing. And if people start restructuring assets out of trusts, there's always a risk as to why you're doing that. And there's no hard and fast rule because there could be legitimate reasons, which may not to amount to anything, to put using Mark's words, not having too much fun. So there might be situations where that's okay, but other situations where it's not. And so people need to tread carefully if that's what they're going to be doing.
So Madison, I think the interesting thing is trusts still remain a very good vehicle for asset protection and for the management of intergenerational wealth when you're trying to pass your wealth that you've generated down to your children or their grandchildren. There's still a super vehicle for that purpose. It's not about avoiding tax, it's about managing and protecting assets within the family situation. And I think if we take the pie example, which is designed to encourage New Zealanders to save, why are you disadvantaging trustees who invest directly in equities in the stock market and force them into going to a pie that's then a managed fund that qualifies as a pie? There's a tension there that doesn't make sense to me. But trusts have their place and should definitely be considered by many, many families in this situation.
In terms of preservation and passing on of wealth, is there anything that somebody setting up a trust may need to think of under these new rules about beneficiaries and who that wealth is then passed on to?
Absolutely, and we've got a new Trust Act that provides beneficiaries a lot more ability to find out what the trust has, which in the past was maybe a slightly murky, and that I think trusts need to be properly managed now. Not only have the Inland Revenue imposed extra disclosure requirements, the requirement to have proper financial statements. There was lots of lazy trusts in the old days where people just didn't administer it properly. They set it up because they read a book back in the time that everybody thought they had to have a trust. Those ones which are sort of the ones that have been closed down and they might only have the family home. But if you've properly got a trust, it needs to be properly managed and administered carefully. And you do need to be careful about who the beneficiaries are, because if they've got a right to know and they go and marry somebody and maybe your beneficiary class is broad, then that brings in somebody else into that category of beneficiary.
Ian, just picking up on one of your points about the use of trusts, I guess with the 39% tax rate, there probably is more legitimate use of trusts now where they are in place. And one point to bear in mind is that there still is a lot of flexibility around trusts and distributions from trusts to beneficiaries. So trusts, they can either retain income that's taxable to the trust and pay tax at the 39% rate, or they can distribute that trustee income to beneficiaries, and it can be taxed at the beneficiary's marginal tax rate. There still is a lot of flexibility in trusts, but distributing to a beneficiary does require the distribution to actually be made, which is a really important point. And then the beneficiaries may have a right to know, or will have a right to know about that. But another important kind of point around trusts is there are a number of other fishhooks as well. And because of the difference between the 39% tax rate for trustees and the PI regime, where income can be taxed at 28%, which is a final tax, so there's an 11% difference. It is important for trustees to be aware of, if they've got an investment that is a PI, what tax rate they choose for that PI. Because if they choose the 28% tax rate, which we refer to as a PIR, then that income is what we call excluded income, so not taxed to the trust. So the 28% is a final tax. But they may want to distribute some of the income to a beneficiary. They can't do that if they choose the 28% tax rate. So that in that case, they might want to choose a lower tax rate, 17.5%, which means that the income is then taxable to the trust, and they can then distribute that income to a beneficiary, which might be sitting on a lower tax rate than the 28% rate. So there are some important planning things to bear in mind with trusts. It's not a set and forget, one size fits all, and so people need to be very careful of those rules.
That's so good to know. Super interesting. Thank you all so much. Appreciate your time.